Today, in our preparation for the Series 6 exam, we are going to tackle a critical and heavily tested topic: the distinction between open-end and closed-end investment companies. Understanding the mechanics of how these two types of funds operate is fundamental to your success. Let's start with open-end funds, which you most likely know as mutual funds. The key word here is open. These funds are perpetually open to new investment. They continuously issue new shares when investors want to buy and redeem shares when investors want to sell. When you buy shares, you are purchasing them directly from the fund company. Conversely, when you sell, the fund company buys them back from you. This leads to a crucial point for the exam regarding pricing. Open-end funds are priced using a method called forward pricing. This means all transactions are executed based on the next calculated net asset value, or NAV. The NAV is calculated once per day, typically at 4 p.m. Eastern Time after the market closes. For example, if you place an order to buy a mutual fund at 10 a.m., you do not get the price at that moment. Your purchase price will be that day's closing NAV, plus any applicable sales charge. This is a very common exam trap. The question will give you a time during the day and ask for the price, but the answer will always relate to the end-of-day calculation. Now let's contrast this with closed-end funds. The key word here is closed. A closed-end fund has a fixed number of shares. These shares are issued to the public in a one-time initial public offering, or IPO. After the IPO, the fund is closed to new capital, and the shares begin trading on a secondary market, like the New York Stock Exchange. This is the biggest difference. You do not buy or sell shares with the fund company. Instead, you trade them with other investors on an exchange, just like a stock. Because of this, the share price of a closed-end fund is not determined by its NAV. It is determined by supply and demand in the open market. This means a closed-end fund can trade at a price that is different from its NAV. It might trade at a premium, meaning the market price is higher than the NAV, or, more commonly, at a discount, where the market price is below the NAV. An exam question might describe a fund trading at a discount to its NAV and ask what type of fund it must be. The answer is always a closed-end fund, because open-end funds must redeem shares at the NAV. To help you remember this, think of it as an open door versus a closed door. An open-end fund has an open door. Investors can walk in any time to give money to the fund or take it out directly from the fund. The price is set by the fund itself at the end of the day. A closed-end fund has a closed door after its IPO. If you want to get in or out, you have to find another investor on the street, which is the stock exchange, to trade with. The price is whatever you two agree upon based on the market's supply and demand at that very moment. The exam will test your understanding of these core differences in capitalization, trading, and pricing. Knowing that open-end funds are forward-priced at NAV and closed-end funds trade intraday based on market price will help you correctly answer a variety of questions.